every day's event, whatever I have taken in this particular month of April. So all these events are being listed here. The most latest video is pertaining to your recent event. So time and again go through that so that you can get more expertise on that particular method. So yesterday you have learnt about how to use 1SD method for doing the option strategy or to form option strategy. In that I have told, based on the Fibonacci retracement price crossover, you have to identify a trending market and a range bound market and an extreme volatile market. Extreme volatile market is a market wherein you have the potentiality to cross the 1.236 to 1.618 retracement level. So for this three different scenario, I have suggested three different kind of option strategy you should initiate, and all the option strategies you will be initiating in the direction of the trend breakout. Maybe the trend breakout will not stand with you, maybe the trend will change afterwards after you initiate the position, but do not worry about that and initiate the trade according to the trend. So this is what I have told you yesterday. So today you are going to learn a fantastic technique called beta decoupling technique. This is a pair trade technique, pair trading technique. So this technique you are going to learn today. So before I go to this particular event, before I start this particular event, I want to draw your attention to specific facts. Today, most of you will be getting our one standard deviation weekly trend report. Look into today's Nifty's high 7738 and compare it with our 1SD levels what we have given for the week, and look into this particular price, what is the high it has made, where what we have calculated last Friday on 8th. So this is what was the calculated figure, this the high what it has happened. So this is the real power of this method, not only in the Nifty, also in Bank Nifty, though it has just 6 to 8 points lacked from this 0.786 retracement, 15,998 you have achieved because of a high base value. So however, you have achieved a close approximate target. So similar kind of result the traders are expecting in the intraday trade using this particular method also. Fine. So I'll move into this particular method of beta decoupling, pair trade technique. So what is a pair trade? What is a pair trade? What we used to do in this particular pair trade method? So we have to identify this. This is also one kind of advanced trading technique wherein you are going to hedge your position with the same instrument. Like if you are having a future, you are hedging the same future with a future. So this hedging technique of hedging a future with another future is known as your pair trade. And while initiating this pair trade, many methods are there. However, all those methods which is being promoted non-scientifically has not proved its loyalty in a long run. However, beta decoupling is one of our best innovation. This is the technique I have come across in the 2005 when my first book on the futures and option I have authored, Master's Key to Futures and Option, the first book which I have authored on 2005. In that particular book I have mentioned about this method, and till this year it is standing tall. It is proving its loyalty from 2005 till now. And this method is a sole innovation of Smart Finance, and we have not copied it from anyone. So what we used to do in this particular method, calculate the stock beta by taking the past 10 days data. What is beta? Beta is known as your sensitivity of one stock along with the other stock. Means if you are having two different stock called X and Y, if X changes by 1%, how much percentage changes Y can give? So that is known as your beta. If beta of X and Y is 0.5, this says that if X changes by 1%, Y will change by 0.5%. And this is a mathematical assumption we are deriving out of that. And whenever this Y deviate from this 0.5 or move beyond this 0.5 or move lesser than this 0.5, we used to say that that is giving you some decoupling. It is not obeying the beta relationship. It is either recording little excess or it is recording little less. So this kind of scenario, whenever we are identifying this decoupling, and this decoupling used to get accumulated over a period of time, and we used to exploit this particular situation and initiate a trade. So why this kind of decoupling happens? Normally this decoupling happens because of the distributions and accumulation of the larger players like mutual funds, like your FIs. Whenever they will start distributing their portfolio, means they have banking stocks, say 10 stocks, and they are just quitting some stocks and allocating the same fund in some other stock. So that also causes a phenomena called your decoupling. So the accumulation and the distribution activity of your larger players, especially mutual funds and the FIs, that causes this decoupling phenomena. And once this decoupling phenomena you can able to identify correctly, you need to enter this trade. So pertaining to this one standard deviation, how we are going to initiate a trade also I will be telling in this particular subject. An ideal condition to buy the dependent is -1 to -2 of decoupling value, and ideal condition to buy independent is +1 to +2 decoupling value. Whenever there is a -1 and +1, between that your decoupling value presents, you need to hedge it by 100%. So this is what this principle says. Decoupling, and here I am using two terms called independent and dependent. So the stocks are the two counters what you will be considering for your beta decoupling trade. One is known as independent and second will be known as the dependent. So which one will be independent and which one will be dependent? That also will be determined by the volatility. So the instrument which will be having the higher volatility, that instrument will be X or the independent variable. The instrument which will be having the lower volatility, so that instrument will be dependent. So when you take two instruments, you have to first calculate their volatility. You have to check which one is having a higher volatility, that will represent X, and the which one is representing Y should have a lower volatility. And besides that, one more rule also it has. The second rule says that whenever you are taking index and a stock in the same index. So whenever you are taking a index and a index in the same, or a instrument present in the same index or the stock present in the same index, that time index will be always independent, because index is not depend on any particular stock. Irrespective of its volatility parameter, index will always dominate the individual stock. Henceforth, index will be always independent and the stock inside it should be always dependent. So this is what the principle of beta decoupling is. So once we are getting this particular principle of the beta decoupling, now our question is, we have to look into a factor how we can exploit this opportunity to take our trade benefit. That is very important. So I am just going to demonstrate the same thing with an Excel sheet. Whatever the rules I have framed here, all these rules are present in my book on futures and options. from 2005. From 2005 till now, these rules I have not changed. So look into that whether market obliged that. So I have taken Bank Nifty, I have taken the State Bank of India. I have taken it for the past 3 months record, Bank Nifty future, State Bank of India future, 31st July till 12. I have taken from the date of 29th January 2016 to 11th April 2016. So this is the date. I have to update this date. So 29th January 2016 to till date I have taken it. Let us see what happened. So I require 29th January till the 10th February. So 11th February till this particular point we are calculating its beta. So the Bank Nifty and SBI beta was quoting at 0.82 and Bank Nifty is independent because it is a index. State Bank of India is a stock, so it is dependent. So based on this particular principle, it says that whenever Bank Nifty will, this is the beta of the first day. This we require 10 days data for that. So this particular data says that 11th February data whenever I will focus it is saying that if Bank Nifty moved by 1%, State Bank of India will move by 0.82%. This is the meaning of the beta. On that particular day, so this is pertaining to its previous data. So whatever the data points it has given based on that. And based on this particular fact, we have found out Bank Nifty has changed by minus 4% in actual term. Same time State Bank of India has changed by 2.97%. As per beta expectation, it should have changed by 3.36%. So 3.36% was expected. However, it has moved only 2.97. So this is the decoupling value it has added. This is the decoupling value it has added. It has a positive decoupling value. So this positive decoupling value it has got added. So we have expected that it should move by 3.36%. However, it has moved by 2.96%. So this is in the actual terms. This is as per the beta terms. So once this is the beta expectation, 3.36 is the beta expectation, and this is in the actual terms. So the decoupling you are finding out from the actual value what you have got minus beta expectation how much. So once you got this kind of decoupling, 11th February you got some decoupling, 12th February you got some decoupling. Before 11th February also you will be having some decoupling value. Yes, this contract starts trading from here. This is this month's contract. This is the April month's contract. It is starting from 29th January. The first day of trading is 29th January for this particular contract. Henceforth I am taking from the first day. It is 28th April contract. So for that only I am taking from 29th January. Day basis, 11th February you got a decoupling value. Again 12th February you got a decoupling value. 13th February you got a decoupling value. So this particular 2 days if you can add on 11th February and 12th February, you are just crossing 2.24. You are just crossing 2.24. So here 11th February and 12th February, we are just crossing the net decoupling value of positive 2.24. So what is my rule says here? Positive decoupling means buy independent and sell the dependent. So assuming you are here, it has expanded, and third day also it has expanded. So here if you are buying here it has crossed to you purchased 13,990 and you sold this 156.25. This is what you have done. So next day it has moved up here, and also your beta decoupling also expanded, and only on the 16th February this is going to, this expansion of beta decoupling which has gone after you initiate the trade from 2.24, it has gone to 5.06 of decoupling, has reduced to by 4.68%. So it has reduced to a great extent. So if I can calculate in this order, so here I am going to calculate, yes, here my decoupling has reduced. So I just want to 16th February all my decoupling values whatever I have calculated, it is got varished. So I am going to calculate what is the profit and loss I got here. So I bought this bank nifty here. So this is the value I'm getting, and I'm taking the lot size as 30. So bank nifty has given me this much. I sold the State Bank of India, it's one lot I'm taking for my simple understanding. So this is what I have sold here, and this is what I am getting. So this price minus 154.85 into 1000. So once this decoupling has perished, which was increased after I initiate the trade, my trade comes to a profit of 7,487. So this phenomena, if you go on checking, here decoupling perished, again decoupling has come, it has again reduced, again increased. So throughout this 3 months data, if you go on inspecting, it is each time it recouples, you are in profit, each time decoupling happens, you are in loss. So same phenomena is going on continuing. So you are just exploiting one phenomena of beta decoupling and in entering a trade. So now you can say all these things past postmortem we have done, and it is saying that okay, it has given a multiple times, it has given great profit, and multiple times also we are forced to hold the positions for a couple of days or months. So here we have to fine tune this particular method. So for that I have taken one more factor which is called correlation. Correlation says that how far they are related with each other. First beta said that sensitivity, correlation said that the relation establishment. So how far their decoupling will be valid. So here on the correlation factor, when I talk about correlation, is a parameter move from -1 to +1. And ideal zone for doing the beta decoupling is from 0.618 or 60% of your correlation to 75% of the correlation. This is the ideal zone in which of correlation, either plus or minus. This is the ideal zone wherein you should do a pair trade. If this correlation is above this point of 0.75 or below this point of 60, then you should not enter a trade. Rather wait for that particular correlation band to come, or else if you have a great value you are seeing in this, and you can say that it has a great value but correlation is not in a favorable zone, even though if you are entering this trade, you have to hedge that trade. You have to hedge the trade. You have to hedge the trade if the correlation is not favorable or beyond 0.75 or below 0.6, either positive or negative. This is the one simple changes we have to do in this. And what is the formula of this beta? That also someone was asking me. This is covariance of x comma y. X is independent and y is dependent. So whatever the price changes the x and y has given, that has to be chosen, not the price. So bank nifty in daily basis, what are the price changes it has given, that you have to take as a x and y divided by variance of x. Variance of x. This factor you have to calculate, post which you have to multiply this particular result with a factor called n divided by n minus 1. So this is the factor you have to multiply. N is nothing but number of days you are considering for this beta. So beta formula is this one. So covariance of x and y, x is independent, y is dependent, variance of x, these are the statistical terms. And if you are taking for 10 days, n is equal to 10. So 10 divided by 9. If you are taking for 30 days, 30 divided by 30 minus 1. So this is how you have to analyze the beta, and based on this beta you have to calculate how much decoupling present in that, and x and y will not be the direct price of the instrument, rather the percentage changes they have recorded in different days. So that you have to take into account, and you have to calculate a beta. Then you need to calculate the correlation. So suppose if you are taking for 10 days data, then 10 days correlation you have to take into consideration, and based on the correlation you have to decide whether to hedge that trade or whether to go with that trade. So this is what you have calculated and you have kept it here. So now question comes, so far I have not entered the trade. So this is from the February onwards, this particular contract of Nifty, Bank Nifty and SBI for April settlement is going on. So the record for the April settlement, the prices for April settlement is available in my hand from January to till date. And once I add up all this decoupling values, I am saying that now I am having a positive of 4.26% of decoupling value. So on 11th April, if I am summing up all the decoupling value starting from January to till date, I am getting this particular thing that it is having a decoupling of positive 4.26. Can anyone will suggest me what I can do? Can anyone will suggest me what I can do in this particular space? I got a positive 4.2. What I should buy, what I should sell? It should be dependent. So higher volatility future will be independent, lower volatility future will be dependent when both the instruments are the stock futures. When you club it with one index, index will be always independent. This is the rule of this particular beta decoupling method. So far we have calculated on 11th April, we are sitting on this particular value. It is saying that 15,876 reference value. Based on that, you should buy Bank Nifty and you sell this State Bank of India. But look into this correlation. Correlation says that you are having a 0.96 correlation, which is not a favorable band. Even though if you enter a trade, you need to hedge it with this particular option. So if the trade is entered in this particular scenario, so what should be done? So the simplest approach is buy Bank Nifty along with, you can say 15,800 put, and sell SBI. Because of correlation only we are hedging it. Sell SBI at 199 and buy a call, say 190 or 200 call you can sell. This is the simplest. You can think of selling something also. One more very strong fundamental aspect, if you can look into this particular thing, you'll get very good result in this particular method. After you get this particular result that yes, this decoupling value is 4.26 and this is the Bank Nifty and this is the SBI, and here this is a very important part of this particular method. Look into these two instruments. Any one instrument like Bank Nifty, as per one standard deviation, very carefully listen this part, as per one standard deviation weekly trend, if it gives a buying side, you have to buy this Bank Nifty and you have to sell this State Bank of India. You have to wait for a opportunity. When Bank Nifty gives a opportunity to buy as per the one standard deviation rule, that time you enter the trade. And that time whatever will be the value of the State Bank of India, you sell it. So here any one instrument. So suppose Bank Nifty is not giving you a buying entry, whether as per the one standard deviation formula, State Bank of India is going to give you a sell entry. If that too also happen, you enter. Out of this pair, In this particular pair, out of these two instruments, any one instrument in weekly basis, if it gives a breakout to purchase or sell, that time only you should enter the trade. Then your success in this pair trade will increase. That time you hedge, do not hedge, that is based on the correlation, take a call. However, in time the trade based on that. You time the pair trade on that particular situation. Wait for that particular opportunity to come. Wait for that particular opportunity to come. Once that opportunity comes, then you enter. So what will happen? After you initiate a trade, definitely this recoupling is going to happen. If you wait for that opportunity and enter, what will happen? Once you enter the trade, the recoupling will start and that recoupling will give you great benefit. So this is how you should initiate the pair trade along with the one standard deviation. And second approach of means hedging it, why to buy a put option. You can think of selling some call option also along with this bank nifty buy. Why to buy a call option for sell SBI. That time you can think of selling some call of put option also along with that. Covered call, covered put, you can convert it to. You can form any other strategy which is suitable to you. But this is how, if you can do this particular method, then it will be highly rewarding. So this is on pair trade, and those who are having our SF integrated tool, in that particular tool which is having 1SD also, in that particular tool we have given this pair trade. So it comes with this beta decoupling as well as some extra information about your Jensen's alpha, Sharpe ratio, Turner ratio, correlation, spread analysis. Many things is getting added here, and it used to come. So, and it is to come with a two features. One is with respect to your intraday, wherein we are saying that beta decoupling is in the expanding zone. That time you should initiate a intraday whenever we are thinking that beta decoupling is in a contracting zone. We are saying that you do not enter this trade for intraday purpose. So with those additional features of beta decoupling, so it comes with this pair trade method with some more analysis into it. So this is an automated tool wherein you just take the analysis and look into this of beta decoupling, what it says, correlation, what it recommends, spread analysis, what it recommends. Another 2-3 more studies is being added here to enhance its accuracy level, and you can utilize it for the positional trade also. So wherein we are recommending that you should hold this positional trade for 10 days. The basic theme of this particular method is like this. Whenever beta decoupling goes above a particular band of +2 or -2, you are initiating a trade, and to confirm and get more accuracy in this particular method, I have just told you a new thing in this, that wait for, in this pair, wait for any one instrument in the pair to give you a buying or selling breakout as per the one standard deviation, so that you should not have to, if you initiate that particular time, you need not have to wait for a long time to achieve the target. You can achieve the target in the quickest possible time. So this is how you can do the intraday and positional trade in this method. And regarding the smart finance products, you can ask your queries whatever you have. I will take it after this. Regarding the smart finance product, you will get this particular pair trade software independently along with our futures and option course. And this pair trade software also comes with our smart IT software. Here you do not get that futures and option course, only you get that pair trade software. So this is two products which is pertaining to this particular things. In smart IT 8500, you get that software alone along with the other softwares. And here if you take pair trade software alone, so it comes with a futures and option course, so that you can implement those pair trade concepts along with the option strategy in a better way. So this is how you can look into this particular courses. And we have some 12 different varieties of products, as I have already told you many times. And those who wants to only learn these particular features and option concepts along with a practice software, they can go for this 12 product which doesn't have a functional software which can help you for trading. However, you have a practice software wherein you can able to practice and you can able to learn. So these things also is there. So this is the 12 different products we have, and if you are going for the entire package of this particular product of all our products, you are getting 163% discount. If you are buying it independently one by one, it costs you 47,000. If you take it together, it costs you 17,500. So this is how our products are being priced. Any query on this, you can call to our sales number here, which is reflecting here, and you can see the detail about that product in the product link. If you can visit to the product link, click in that, go through that link, it has many details about the product. In detail, I have told you how the beta decoupling is being designed, what is the basis of this particular method, what is beta decoupling, how to initiate the trade in that beta decoupling, what are the situation you should wait for to enter this trade. In the most simplest manner, I have explained it to you, and I have also proven you here. Whenever beta decoupling expands and it recouples, that situation gives you profit. Similar way, you can simulate this thing and you check it for the past 3 months, 4 months. Whenever it decoupling happens, you are in, and you wait for that opportunity and enter in a proper time. And once that decoupling recouples, you get a profit. So this is how you should enter a beta decoupling trade. Any question in this regard? Make it very clear to all of you. Whenever because this particular tool is present from the 2005, many have bought it and they have renewed it year on year basis. So whenever any new features is get, that time pair trade was not a part of this product. Even though before 3 months or 4 months, one standard deviation also was not a part of this product. Gain angle and volatility was not a part of this product. But those who are renewing that particular product, all these extra features, whenever it comes free. However, if you have not renewed, used it for a year, then discontinued for many years. And again, if you are coming back to us, so asking us that you give us that things, I'll just renew and give it. We cannot give. You have to buy the product in totality, because your informations, once you used it, it is already over. The promised amount what we have taken, we have given the service and service is over. Post service is over, you cannot claim that yes, now you have added new features in that, I'll just renew and you give me that things. That will not be considered. The renewal is only when your product is in active state and you are renewing. That time we consider you as a loyal customer and we consider you as a customer who is being with us for a long time. So we give this facility to them as an incentive to their loyalty. So those who have taken the product, used it for a year, discontinued for 1 year or 6 months or something, and then they say that no, you have added new features, now you give it in a very discount price, we cannot. So please do not put such kind of things.